I often joke the one constant in the ag sector is whatever happens, farmers get screwed. And I'd like to see that change. One, two, three.
Coming up, we're talking to Adam Bergman, the managing director at AgTech Capital, all about the ugly, the bad, and the good of AgTech investing right now. The Modern Acre is presented by Yield. Yield turns on-farm energy assets like irrigation pumps into virtual power plants. Yield helps growers save more money, be more profitable, and helps utilities get access to flexible load and capacity in agriculture. To learn more, check out yieldenergy.com. And if you're a grower, check out yieldenergy.com/growers. One thing I love about doing this podcast is we just get connected with awesome people, and we're able to network and build relationships with people in ag who are really passionate about agriculture. Adam has been someone that Tim and I have followed for a long time, followed his work. He's always putting out really good content on LinkedIn, all about ag tech and investing and covering indoor farming to automation to all the different segments within ag tech. And we just love to hear what he has to say in the space. He's in investment banking, so he helps companies raise capital, sell their companies, and he's really on the front lines of what's happening in the ag tech sector. And he put a piece out recently about the ugly, the bad, and the good that's happening in ag tech investing right now. So we dig into all of that in this conversation, and there's so much good content in here you guys are gonna love to learn from Adam and what he has to say on the industry. So we hope you guys enjoy this conversation. Let's jump right into the conversation with Adam with what's top of mind.
Well, I think what's top of mind is what's going on in ag tech and food tech and what's going on with this sector. We're probably year 3 into what I think is a pretty challenging period. And I think, like many other people in this industry, there's a lot of questions of where is the sector? How do we turn this ship? And how do we put it in a direction where we can see a lot more success than we're seeing today? And I feel like I spend most of my time having those conversations and trying to work with companies to help get them and this industry on the right trajectory for success.
100%. And we're excited to dig into all that with you today, get your thoughts. First, Adam, would love to learn a little bit more about your story and your journey. Tell us a little bit more about yourself and what got you into ag.
Sure. So I think my story is probably a little different than most. So I've been working as an investment banker for about 3 decades. And really in that role, I work with companies to help them raise capital, work on mergers and acquisitions, and help form strategic partnerships. And through that time, really, I've spent my career working with high growth companies. I was doing work in healthcare internet in the late 90s, doing internet and tech in the early 2000s. And in 2004, I fell into solar. And really, the last 2 decades, I've worked at the intersection of what I call as tech innovation and climate change. A lot of renewable energy initially, stuff in utility technologies from energy efficiency to smart grid and smart meters, and a lot in mobility from EVs and natural gas vehicles to shared mobility and autonomy. And in 2016, I joined Wells Fargo to lead their work around clean tech. And in doing that, I was approached by their team, who were the largest lenders to production agriculture and one of the largest lenders to just the broad food and ag sector. And they asked me to help them. And it was an interesting conversation because they said, what we're finding today is technology and innovation have an opportunity to really transform the food and ag sector. And if our customers are able to bring in technology, we think they'll be more successful and profitable, and our loans will be less at risk. However, if they don't use technology or use the wrong technology, our fear is they're going to make less money and our loans will be more at risk. Can you help us think through how we bring technology into this industry? I had done some work in ag and food tech before that time, but it wasn't a focus. But really, since that point, which is about a little over a decade ago, it's been one of my main focus areas. I spent a lot of time in it. While at Wells Fargo, I did some really interesting things. Like I helped them build IN2 Agriculture, which was their incubator at the Danforth Plant Science Center, which was a pretty cool experience. And really, over the past decade, I've done a lot to get ingrained in this industry. I've done a lot with Western growers, where I'm a tech advisor. I've done a lot with Landis over the years. We're helping them from a tech advisory perspective. There's another entity called See Ahead out of Boston, focusing more on the ocean, that I do a lot of technology advisor. But to me, it's really, my role is I try to be at the intersection of where companies and investors and large corporates are to help bring this organizations together. And that's really where I see success come, which is agriculture is tough. And I always say to people, I'm never going to be the smartest person in the room in agriculture. I grew up in the suburbs of Connecticut. I've lived my last probably 30 years between New York City and San Francisco, not two agriculture meccas. But in my case, my wife comes from a family of dairy farmers. She's English, and they kind of trace their family roots back about, I don't know, at least 1,000 years to being on the land there. So they have an agricultural side, which I've learned, and I've picked up a lot during the years to get smarter. But my journey here really is just excitement, because I look at the ag sector, which they often refer to as one of the least technologically advanced, or least the slowest to bring in, particularly digital technology, and just see an opportunity ahead. I think it's incredible that's what's ahead of us. And it gets me excited because I can see a real transformation. And I say this to people all the time. I see this opportunity for farmers to make more money. I often joke the one constant in the ag sector is whatever happens, farmers get screwed. And I'd like to see that change. And so I'm hoping tech is going to be one of those areas where we can help farmers make more money.
Adam, really excited to dig into kind of your perspectives. You've been working in the space for decades in agriculture, and I know you have a lot of views. But before we jump in, let's maybe kind of get the lay of the land with investment banking. I think that term gets thrown at a lot. Can you just give us a refresher on kind of how it works when you're kind of targeting companies to work with, either from the buy side or sell side? Maybe just talk to us about kind of the structure.
Sure. So from a general investment banking purpose, my role is either on a financing, where I'll help companies prepare and then get ready to go out and raise capital, and then be an intermediary between them and investors, whether they're financial investors or strategic investors. Or if we're doing mergers and acquisitions, I'll either represent the company when it's looking to acquire another company, or looking to sell its business to another company. So it's really many different roles, but my main purpose is to help the company. I sit there with the company. I'm their advisor. I give insight. I help position them. I help them in this market. I think one of the most important things is create, how do they mitigate the risk factors that they're facing? And then how do they find the right partners to be successful? And I often say to my clients, particularly when raising capital, it's important to find partners, investors who are going to be there with you in the long term, but also who are going to help you be more successful in the long term. Just finding someone to invest in you today who might put a higher valuation, that's not maybe the right partner. You want that partner who's going to give value to your company, as well as help you get a higher valuation on a future financing round or a future sale. So it's really working closely with companies to help put them in the best light when they go to raise money or sell themselves, to help them mitigate the risks that they face, and to help them really just understand what can be a really difficult landscape, whether it's M&A or capital raising. And I would say there are times when M&A and capital raising could be relatively straightforward. And we saw that in 2020, we saw that in 21, maybe even stretching into 22. That's typically an anomaly. Most of my 3 decades, the markets are challenging. And right now, we're in probably one of the most challenging time horizons. And the role of an investment banker is really to be a coach, someone to guide a company, and someone to really help them reach investors that they just don't know who they are or how to find them.
You have been on the front lines of seeing what's happening in AgTech, which I think is, you really have this unique lens, because you actually see in detail all this in action and how this materializes with when money is flowing, there's dry powder, and money's flowing versus time versus now where maybe there is dry powder, but there's a much higher bar for investors to invest. All right, Adam, you put together this outline, kind of doing an overview of where we're at right now in AgTech investing, and you, I think, appropriately titled it the ugly, the bad, and the good. I want to walk through this with you. So why don't we go through each of these and spend some time in each of these different areas? Can you let's start with the ugly. What's the ugly right now in AgTech?
Yeah. Sadly, the ugly is most of where we are with the companies in the industry. And I don't say this because the companies themselves are ugly or anything about the industry is ugly. It's really where the companies are from a stage of development. We're in a really difficult position today where you have a lot of companies, many of whom raised a fair amount of capital between 2020 and 2022 or 23, based on the fact of where the market was and where valuations were. A lot of them put together business plans with very robust projections that, if we took a step back and were honest, were probably not achievable. Or if they were achievable, it was only in everything that could happen working out. It was in the best case scenario. And now we're at a point where a lot of those business plans didn't work out. Companies have burned through their capital. They've probably had current investors funding them in maybe a safe round or some other type of instrument just to give them a little capital to keep going for a year. But now we're at year 3 of this process for some of these companies. And what I've said is a lot of times we found investors continue to fund these companies with the expectation of one or two things. Either A, these companies are going to find their traction from a business perspective and will get some scale and can grab some more revenue and hopefully get to a point of EBITDA or close to EBITDA. Or 2, the financial markets will rebound in a way we saw in 2020, 2021, and they'll just be flush with capital and any company going out will just be able to raise it. The reality is we're sitting in 2026 now, and I think it's pretty clear that neither of those two things are going to happen. And what does that mean? Well, I think it means we're going to see a really difficult year where there's going to be a lot of bankruptcies. I think we're going to see a lot of fire sales. We're going to see consolidation. And we're going to see a right sizing of an industry that got too big. I think it's reasonable to think that between 2018 and 2022, $40 billion was raised globally for food and ag tech companies. I think we got to take a step back and think about that number. That is a really large number that went into this industry. And candidly, we're probably, if history, in my experience, is anything, we'll see upwards of 70% of that capital go away. It's either going to go to because companies will go bankrupt, or they'll cease operations, or they'll be sold in fire sales. We're going to see, I think, the proverbial flushing of capital down the drain. And that's kind of where the ugly is. It's where do these companies that aren't going to make it, what happens to them? And the positive is there are going to be companies who make it. So let's be very clear as well. Although it's ugly, it's not ugly for 100% of people. It's going to be ugly for a lot, but not for everyone. And I think you'll see in 26 really the bifurcation of winners and losers in the sector emerge.
Such a good overview. I agree with you. We have to balance the negative realities and the optimism and the positivity, which we're going to get to with the good. But of this situation that you talk about with these kind of zombie companies, I think you referenced, like what is the breakdown of like companies there? Because I see kind of two camps here. One is companies that just fundamentally don't work, right? Just forget the valuation, forget how much they raised. Like there are certain companies that just don't work. Okay. And those I would imagine are going to be in the bankruptcy bucket. Yep. I imagine there is some portion of these companies that work, but they just don't work at the valuation that the VCs were hoping for. So like, can you what I'm trying to understand, or what I would like to unpack, is for that second camp, companies that maybe they've gotten to EBITDA positive, maybe they have a traction in a certain market, they're just not $1 billion company. Like, what are the options there? Like, are there funds out there that are buying up these types of assets, or is this just not sexy to like pick up this startup that was raised at $100 million valuation, but they're making $1 million a year, and maybe they could be a nice business that can grow to a $50 million business. Like, what are you seeing in that space?
Yeah. So first of all, you mentioned a company who, whatever their revenue, had EBITDA. If a company has EBITDA, the odds are that they will survive. So they'll either be picked up by someone, or they could survive on their own. Let's talk about where 90+% of the companies are, which is pre-EBITDA and profitability. One of the things that's been really interesting, although I can't say totally surprising to me, is the lack of roll-ups in this industry. And one of the things, when I've talked about with some of the people who you would expect to have led the roll-ups of this industry, I'm often hearing from them is, look, some interesting companies, but we run into a couple problems, which is, one, they look at a lot of these companies and think, not only do we have to pay to acquire them, but we have to make a significant investment into that business to get it to a larger scale where it can be profitable and be more impactful. And two, we have to get it to the customer. And let's be very clear, a lot of the challenges in this industry revolve around getting to a customer. If it's AgTech, it's typically a farmer. If it's food tech, it's a consumer. None of it's easy. And so you talk to some of these people who you, again, would sit there and think, these are the guys who should be consolidating and rolling up this industry from a PE perspective. They sit there on the sidelines and are not thinking about that. And by the way, we see that in the corporate, and I'm sure when we get into the bad, we'll talk about M&A there. But we see it on the corporate side too. There hasn't been anyone doing a lot of buy-ups and roll-ups, and it goes back to the companies. And I think one of the things that's really important, we're going to see a lot of failures in this industry because it was the wrong business, could have been wrong management team, poor execution. We're going to see some failures because the technology that was being developed is a 10 to 20 year time horizon. And very few companies get 10 to 20 years to develop a product. And that's just somewhat of a reality of what's going to cause some of these failures. But you're going to see failures for both reasons. And candidly, to some degree, it's just going to happen. There's very little anyone can do about it.
Adam, you mentioned that some investors have maybe written down their investments a little bit, but maybe 25% of it. So you kind of implied that there's a little bit more pain to come for investors. Maybe talk to us about kind of what the process is there to write down an investment or have a down around what the implications are for the investors and the companies, the founders themselves.
Yeah. So we're at a point where that's going to accelerate in my mind, these write downs. And what's going to happen is investors are going to sit back and think, we have two choices. We could either write down or walk away from these companies, or we could keep funding them. And by the way, there's a couple options on funding, because you could fund a company after pretty much doing a restructuring and getting the valuation back down to a lower, more reasonable number. And there will be some of that. There'll be some of those type of restructurings where they say, look, the last round was done at 200. And they'll go to the investment group and say, we're willing to put in $2 million and the new valuation is $5 million. I've seen some where they've come in and said, new valuation is pre-money is $1 million. Anyone who wants to play, put your money in. If you don't want to play, we're going to write it down to zero. And so some of that's going to really play to the investment community. And one of the challenges in the investment community right now is there's not a lot of new capital in there. And there's not a huge amount of capital from existing investors, because a lot of them have gotten to the end of their fund life and can't raise new capital. And I'm probably jumping the gun a bit because this is kind of the bad, but that's what we're in right now. So there's investors who have capital and want to put it to use in existing portfolio companies have a tremendous amount of really leverage, because they can go back to other investors and say, here's your option. you either company runs out of money, or we could put in a little money, but we're resetting the valuation. And what they often call is pay to play. Anyone who wants to continue investing into the company, when we reset the valuation, great, put your money in and you get equity at that valuation. But if you don't have money to put in or don't want to, your equity is probably going to be written down to almost nothing in some places. And then you're going to have other areas where you're going to have fights on the board where they're going to say, no, we don't want you to write it down. We think we could continue on, or we should try to find someone to buy it. And I could tell you from my experience in other clean tech areas, it's not unusual for fights to happen internally and these companies to go under because the board is just focused on, is there any value to extract? And they don't want to do a reorg or restructuring because, to a point I think, Tim, you might have been getting to, when you rewrite down the valuation, you're resetting value of that company. And if you're an investor, all of a sudden, you're taking a write down where you said this company was worth 100 million, it's now worth 10. And that is not always the greatest thing, particularly as you're talking to your LPs or you're looking to raise new capital. Investors are always happy to talk about, hey, we just completed a round, it was up 20%, and sing praises. There's not a lot of investors who want to say, hey, look, we just did a reorg, we're down 75%, but the company's great. It's a challenge.
You just alluded to it. Let's get into the bad. Walk us through the bad of what's happening.
So the bad really is the challenge this sector's faced in its lack of exits. If you go back over the past, we could go back a decade even, you had a spate of some really interesting technology exits in 2018, 2019, 2020, 2021 with the Blue River and Granular and Bear Flag and Prospera, who were all companies with less than 5 million of revenue who sold for 250 million or more. And let's be honest, both as an investor, as an entrepreneur, as an investment banker, we're all aligned here. We're all excited. That's fantastic. We love to see those deals. The problem is those are really difficult deals in agriculture. You might see them a lot in tech, but you don't see them a lot in agriculture because people don't usually buy technology at huge premiums. And that's why we saw 4 deals rather than 40 transactions. And one of the challenges we now faced is there just aren't exits. So these investors aren't getting the returns that they need. When they don't get the returns they need, it puts them in a very precarious position if they try to raise a new fund, because they go to LPs and say, hey, we're looking to raise a new fund. And the LPs say to them, okay, great, walk us through what returns you have in your last fund. And there's not a lot of returns in the last fund. And that has really put the sector in a difficult position. Because as I mentioned before, now you're talking about investors who don't have additional capital because they've either used it on the current fund and they haven't raised a new fund, or we've seen a huge number of investors leave this industry. They just have said they were either generalists or they did one fund here and they realized this is where they didn't want to put their future. And we've even seen strategics who've retrenched significantly. Some have closed their venture funds. Others have really just stopped investing for all intents and purposes. So we're at a place where we're not getting exits. There's not a lot of new capital coming in. And we're seeing a squeeze. And that's a really troubling situation for this industry, because if it continues to get squeezed, even successful companies are going to be at a disadvantage because they're not going to have the capital to scale quickly. And as you both know, one of the things we see in agriculture is organic growth is really difficult. You do not see, it's not enterprise software. You do not see businesses go from 1 to 25 to $100 million. They go from 1 to 3 to 5, maybe to 10. And so if a company is starved for capital, they're going to even grow slower because they're just not going to have the resources to do it. So that's a big challenge. Even successful companies, if they don't have capital, are going to be at a disadvantage here.
Yeah, I feel like that gets thrown out a lot of just like, is venture the right model for agriculture? Like to the points we just mentioned of like, is 10 years appropriate to return a fund? Maybe not. And like your point about kind of the lack of unicorns where VC is entirely built on the power law of like having those outliers, those $1 billion companies. And like in reality, if it's, $200 to $300 million for the big exit, does that really justify building a fund? Like, have you thought about kind of alternative capital structures for these kinds of companies?
Yeah. So the first thing I'll say is based not, and I always like to say, because I think it's important, I don't focus specifically just thinking about ag tech and food tech. I go back in my decades of doing this, and particularly around the clean tech era where I've spent 2 decades plus, venture hasn't seen fantastic returns. They've seen some nice deals back in '05, '06 with solar. Maybe they saw some. If you were part of Tesla, you got a fantastic return, but there haven't been tremendous amount of returns in a lot of these areas because they just take a long time. And I often say to people, there's a lot more in common between agriculture and food, energy, utilities, and transportation than people understand. The analogy I often say is, look, these are industries that have been around for a century, or in the case of ag, millennia. These are sectors that are typically have oligopolies who are leading them. These oligopolies have capital, name recognition, distribution, and fight new entrants. And so companies in all these areas face the same challenges, and they're really difficult challenges to overcome. And market traction and timing is typically one of the top ones. And I say to people, I remember doing EV work back in '06 and '07, and people used to say, oh, we'll have 25% EV penetration in the US within a decade. Well, we're 2 decades on. I think penetration's still like 6%, maybe. It's a really low number. Stuff doesn't happen quickly. And so to your question of models and investors, I've always been a big believer that corporate strategics typically are the best investors for this industry because they understand the time horizon and the risk tolerance as well. I think family offices who take a longer term horizon as well, because they don't need to give money back typically in that 5 to 7 or up to 10-year time horizon. Sector specific venture is fine because you would hope, at least the ones I know, have a good understanding of the industry, and maybe they have a little room to push it a little bit more than the 10. It's typically the generalists. And again, I have no problem with generalist investors. They do a good job and they invest into many things. The problem is they typically invest into these industries and just don't know them that well. And I always joked when venture came into solar and biofuels in '06 and '07 and '08, and then the financial crisis happened, I used to say, when the going got tough, venture got going. And they just walk away from all these companies. And that to me is the biggest issue. It's not per se the time horizon, which it can be an issue, but you've got to think about this. If you are a company taking money from a generalist venture player, that generalist venture is probably going to make 30 investments. It's probably going to make 15 to 20 in tech. It's going to make 5 to 10 in biotech. And it's going to make like 1 or 2 in this broad clean tech area, including ag and food tech. And if things aren't going well, where do you think they're going to continue funding, and where do you think they're not going to continue funding? They're going to walk away from these areas where they make 1 or 2 investments. And I think that's a huge risk for companies.
I think we've seen that in climate. There's been like a ton of climate tech funds that it was very trendy to dabble into agriculture.
Yep.
And they no longer dabble in agriculture.
No. But I'll tell you this, and I think it's really interesting. People got really excited about the climate funds because I think it was 2018 or 2019, the UN put out some report that said agriculture will provide the second largest emissions after energy, even more than transportation. And you had all these people get excited, and I got all these calls and had all these conversations. But the challenge is, and you guys better than me even know this, what percentage of people in the finance industry grew up on a farm or have a connection to a farm? If you're at a climate tech fund, to some degree, we all understand energy. We all understand transportation. We have cars. We get electricity. We get it. We get that. Ag is different. And I think a lot of people stepped into an industry they maybe thought they understood when they didn't. And that's some of the challenges you're seeing, that people put money in expecting it to be different. And now they found agriculture is tougher. It takes a long time to actually get traction.
Totally. All right, let's let's move to a bit more cheery side of things. Talk to us about the good. Like, where do we go from here? What are the things that get you personally excited and optimistic about the future here?
So the best part of the good is I've seen no technology today or in the future that's going to stop us from needing to eat food. So as a starting point, that is a great place to be. Additionally, talking about really mega trends that I'm focused on, which are food security. We saw post Russia's invasion of Ukraine, there was a real retrenchment, and a lot of countries stopped trading agriculture for a short period of time, and it scared places. Because if people don't remember, back in 2012, there was something called the Arab Spring that took out a multitude of countries because they could not feed their people. And let me tell you, there's a lot of countries out there really concerned that if something like that happened, they're going to be taken over as well. They're going to be overthrown. And so there's been a lot more focused on food security. 2, health and nutrition. I don't know, whatever number we want to use, 70% of Americans are overweight, 40% are obese. Sadly, America is not just leading the way, everyone's following us. So those numbers are getting to be similar in a lot of other countries. So there is a huge focus around health and nutrition. Thirdly, sustainable food systems. One of the things that's apparent to me is we're going to struggle to produce more food, particularly a lot more protein, and with similar amounts of land, similar amounts of water, and similar amounts of crop inputs. So we're going to have to figure out how we're going to feed the world, which is continuing to grow, and without having a lot more resources to use. And I think that's going to be a tech play. And then finally, just fitting in this theme, you're running into 2 things I think are pretty interesting, which is we are seeing just tremendous innovations around technology and biotechnology. And when I see that, a couple places today that really excite me, probably the top 2 are automation and robotics and digitization. I think automation and robotics is just going to be game changing, particularly on the farm. And I often tell the story of I was doing some work around some hardcore, like industrial areas more than 2 decades ago, castings and forgings, which are big pieces of metal. And you'd go into these facilities and there'd be fire shooting everywhere. It was crazy. But if you look at some of them today, these new facilities being built, those old facilities, not a lot of tech, not a lot of automation, robotics, a lot of human labor, not a lot of efficiency. You go today, these new facilities, automation and robotics, IoT, AI, machine learning, not a lot of humans. And in my mind, that's the road for the future of what the farm's going to look like. Again, I'm not saying 2 years from now, there's not going to be a human on it. But if you ask me 15 years from now, it wouldn't surprise me. And again, that runs into a couple other things like labor. Labor is a huge problem. And irrespective of what happens in an election in 2028, the U.S. is going to have a labor problem on the farm, and it's going to get worse. And it's not because of immigration per se. It's just as much the fact that people have realized that working on a farm is really, really difficult. It's hard to do. It's backbreaking, and a lot of times you have to do it in 100-degree weather or really cold weather. It's not easy work, and you could get an equally paying job working at a McDonald's or someplace, and that's really going to make it a need. I always go with necessity is a mother invention, and to me, automation robotics is there. And then the digitization side, I speak a lot about AI, and I speak out of both sides of my mouth, because on one side I say we're in a huge bubble, and I think having worked in the internet during the .com time, I've seen a bubble, and I see what happens when it implodes, and all the characteristics of AI show implosion. That being said, I'm pretty confident that all of us today are to using the backbone of the .com era, whether it is a site that we're using or the infrastructure. Just because there's a bubble, and even when the bubble bursts, doesn't mean AI is going away. And I'm seeing some really, really impressive things on the farm. I've seen some companies doing some AI computer vision. I think you're going to see them. Again, to me, The farm today, and I don't say this disrespectfully, I often feel, and I'm a big supporter of the farmer, that the farmer is the emperor who has no clothing, because the farmer is trying to farm but doesn't have all the information, and this makes it really difficult. I actually think, and I'm really optimistic, that with automation, robotics, and digitization, the efficiency for the farmer is going to improve greatly. Yields are going to improve, costs are going to go down, and most importantly, the farmer is going to be more profitable. Again, this isn't an overnight. It's going to take some time, but I actually think technology is going to make the farmer more profitable, and I think that's probably the best thing that's out there.
No, I definitely agree with you. There's a lot of global macro trends that are happening that companies can kind of hang their hat on and ride that wave that are going to be here for the long term. And equally as important, I think this downturn is creating financial discipline with companies where like they're being more efficient with the capital that they are being able to raise. And to your point about AI, I think you can do a lot more with AI now building a company than you could 3 or 4 years ago when money was flowing easily with a lot of these tools that are out there. So I think the companies that are able to weather the storm and, like you said, the survival of the fittest are going to be in a good position when markets turn around in the next couple of years.
And I was going to say to your point, I think, and I talked about in my article, that if history is any example, companies who are successful in lean years thrive when the markets are good. And so I think forcing discipline for a lot of these companies who use the financial markets as an ATM and an expectation of I'll just go back next year and get more and the following year more. And now they don't have that. I think that's going to be good for them. I think it's really going to force these companies, one, to have more of a focus. I feel a number of companies who raise lots of money started to broaden out what they were doing rather than being laser focused. And I think laser focus is going to be important. And two, I think it's going to say, look, do you have a real business? If you have to show I can generate revenue and I can generate EBITDA and profitability, you're going to figure out whether you have a business. And by the way, one thing that's great about America is entrepreneurs can have a failure and come back. You're not stigmatized. So I think a lot of entrepreneurs are going to look at their business and say, is it going to work? And if not, maybe the answer is, look, let's close it down and let's take a step back and think about it. And maybe there's a derivative of our business or a totally new business that we should develop and see how we can actually make it profitable. Because that's the future. The future is profitability here. I just think I understand we talk about tech, but I just think too often we're not focusing enough on how do you build viable businesses. And the reason, by the way, that's really important, and I say this to my clients all the time, when we talk about exits in this industry, there are some IPOs, but let's be honest, there's not going to be a lot of them. Most of them are going to be M&A. But the challenge with M&A is if you don't have a profitable business, your M&A route are strategics. And I've already said in a lot of these areas, we're talking about oligopolies. So there's not 50 buyers, there's 5 to 10 buyers. However, if you develop a business that actually is profitable, all of a sudden you open a whole new window to PE. And one of the things I think a lot of people in the tech venture world don't realize, for ag and food, PE is a huge area. Middle market PE buys so much food in ag. They want, by the way, to buy AgTech. They just aren't willing to buy AgTech companies that don't have cash flow. And so that's what we're talking about now. How do we build sustainable businesses that are going to appeal to the PE crowd who can really have a huge role in helping this company achieve exits, but also developing them into bigger businesses because they can merge them with other portfolio companies and really scale them. So the good for me is this opportunity is tremendous. We're just in a difficult, volatile position right now that we'll get through. It's just going to stay. It's probably going to be hard in 26. And I'm optimistic once we get into 27, we're going to see a lot of the fruits of labor of consolidation and profitability helping to drive these companies to success.
I have to ask one more follow-up question. And that is on what you just proposed with or suggested with the PE buyers, is the challenge, I would assume the challenge there, that sounds nice, but I'm assuming the challenge there is exit expectations for founders versus what PE will buy at. That's probably the tension that path has.
So I would agree 100%. PE is not going to come in and value a company like venture does. But I would also offer up, I'm not sure a lot of these companies should have been valued the way they were by venture. And so I often say, if you start at a smaller, more reasonable valuation and you think your exit is 300, then how you build your company one way makes a lot of sense. If you start off and your A round is 100 million valuation, the odds of you get an exit at 300 where people are going to be happy is very low. So I actually think in many regards, raising smaller rounds and more reasonable valuations, particularly in the beginning to start growing some of these businesses, is imperative. And having that laser focus on the business rather than raising more money and trying to scale either quicker or in a broader ecosystem is probably a better strategy. Companies that raise too much money at too high valuations in this industry are going to find a lot of challenges, because on one hand, the investors are going to expect huge returns. And on another, let's be honest, how many billion-dollar valuations on M&A are we going to see? I just don't see a lot of the ag companies or others in this industry making acquisitions. And while they could go to an IPO route, I often say the last AgTech IPO I'm aware of any significance was Monsanto. And that was a long time ago.
Adam, this has been a ton of fun. I think this is a great place to wrap it. As we close out here, how can our listeners get in touch and connect with you?
Well, they can find me on LinkedIn, but also they can get me at ecotechcapital.com, ecotechcap.com. And I think I'm around on a lot of places and talking to a lot of people. So I'm always happy to talk to people in the industry, because my number one priority is to see success here. And if I could give guidance or insight, and you guys are doing a great job of to kind of bring knowledge, we're all aligned in the same way. To me, the main thing is, how do we get companies to a point of success? Because that's what's going to be good for this industry. And any role that I can play in that, I'm really happy to do it.
That's it. That's the pod. Man, I just felt like I could ask so many questions of Adam, wanted to go even further, because he just has such a wealth of knowledge about what's happening in ag tech and investing right now. Hope you guys got a lot of value out of that. Be sure to follow Adam on LinkedIn, follow what he's up to. Appreciate you guys listening. If you are not already, make sure you're subscribed to the Modern Acre podcast, wherever you listen to your podcasts. We appreciate the support and you following.